Welcome to the Deep Dive. We're your shortcut to really understanding the crucial conversations happening in the market. Today, we are taking a close look, a deep dive, into Intuit's latest earnings call. This is for their Q4 fiscal year 2025, the period ending July 31st, 2025. Our mission for you today, simple. Cut through all the noise, pull out the key numbers, the strategies, the insights, basically get you quickly up to speed on Intuit's performance and, where they're headed.
Exactly. And Intuit, well, they've been a really interesting company to watch, haven't they? Seeing how a, let's say, legacy software player pivots, especially with this big push into AI and expanding their platform.
Yeah, it's quite the transformation story they're trying to write.
Right. And this earnings call, it wasn't just about the recent numbers. It really laid out their narrative, their story about where they see themselves going in, well, what's clearly a very fast-changing market.
Okay, so let's jump right in with those headline numbers. Because, on the surface, Intuit put up a really strong Q4 performance.
They really did.
Their non-GAAP earnings per share, the EPS number, came in at $2.75. That easily beat the consensus, which was around $2.66. So what's that? It's a solid 9-cent beat.
Yeah.
About 3.4% better than expected.
Yep, pretty solid beat there.
And on the top line, revenue hit $3.83 billion, again, nicely above the $3.74 billion consensus.
Yeah.
That's a 20% jump year over year, pretty robust.
Yeah, 20% is definitely strong growth. And it wasn't just the top line either. If you look at profitability, that showed some real strength too.
Right, like the GAAP operating income.
Exactly. GAAP operating income was $339 million, which is a huge turnaround from last year when they actually had a loss of $151 million.
Wow, okay.
And maybe even more impressive, the non-GAAP operating income, that surged 39% year over year, hit $1.016 billion.
Almost 40% growth on non-GAAP operating income. That's significant.
It is. And what really stands out is that the strength was pretty broad-based. You look at global business solutions revenue, up 18%, and actually 21% if you pull Mailchimp out of the mix for a second.
Okay, we'll come back to Mailchimp, I'm sure.
Oh, definitely. And their online ecosystem revenue, that grew 21%. Or, again, excluding Mailchimp, even stronger at 26%.
So, strong underlying momentum there. But here's something that really caught my eye, and probably yours too, listener. TurboTax Live revenue. That's their service with the, human expert help.
Yeah, the hybrid.
That saw just breakthrough adoption, grew a massive 47% year over year.
47%, and that's a 30-point acceleration from the previous year's growth rate. It's huge.
It really is. And Credit Karma, another key part of that consumer platform, that wasn't exactly slacking either. Up 34%?
Right. So fundamentally strong numbers, strategic wins. It looks great on paper.
But, and there's always a but, it seems, the market reaction was, well, noticeably cautious.
Yeah, that was the interesting part. Despite these strong beats, impressive growth, the stock took an immediate hit, dropped, 5% to 7% in after hours and pre-market.
Right. So what gives? You have this strong performance, but investors are clearly nervous.
It really highlights this key tension, doesn't it? Intuit delivered on the present, Q4 was strong. But investors, they were looking squarely at the future, specifically what they saw as kind of conservative forward guidance for the next fiscal year.
Ah, the guidance.
Yeah, that and also some, let's call it acknowledged underperformance in one specific area, which I know we'll get into.
Mailchimp again, presumably.
That's the one. So it's a classic case, really. Especially in tech right now. The market's prioritizing that future outlook, maybe even overreacting to it compared to the current strength.
It's fascinating. Strong results today, but jitters about tomorrow. Really shows how sensitive the market is to guidance right now.
Okay, let's dive deeper then. What's driving the core strategy? Let's start with that AI-driven transformation everyone's talking about.
Right. This is central to their whole story.
They're clearly committed to this vision, this AI-driven expert platform, trying to weave together data, AI, human intelligence, create this all-in-one solution. What does that actually mean in practice? Why is it such a big deal for them? Well, it's definitely more than just a buzzword for Intuit. They're really trying to fundamentally reimagine their products. The vision is a platform where AI isn't just, helping you out. It's proactively anticipating what you need and actually completing tasks for you.
Okay, so more proactive.
Exactly. And they showed this off with the launch of their new AI agents, rolled them out in QuickBooks and TurboTax back in early July.
AI agents, so what do?
Their purpose is really to automate workflows, the kind of stuff that takes up a lot of time. deliver real-time insights, maybe for cash flow management, that's a big one, and literally complete tasks on behalf of the customer. Think of it like a virtual assistant or team member for a small business owner, or, a personal finance helper for an individual. It's about moving from just giving you tools to providing solutions that actually do the work.
And are people using them? What's the early feedback?
The early traction sounds, well, frankly, incredibly promising. Management talked about millions of customer engagements already. And maybe more importantly, repeat usage rates are significantly above expectations.
Okay, millions of engagements, high repeat usage. Why are those metrics so important right now, even before they really start monetizing these things?
They're absolutely critical because they validate the whole value proposition. High engagement means people are finding these agents useful. High repeat usage, that means the value is sticking around, it's sustained.
Right, it's not just a gimmick they try once.
Exactly. For Intuit, this builds a really strong competitive advantage, a moat. If these agents can genuinely automate complex financial tasks, provide real benefits, it makes their platform incredibly sticky, hard to leave.
Makes sense.
And the company was careful to emphasize, while they have high hopes for monetizing these agents down the road, none of that potential revenue is actually baked into their fiscal year 2026 guidance.
Okay, so they're being cautious on the guidance front regarding AI revenue.
Yeah, which seems prudent, kind of under-promising and until they're absolutely sure they can deliver on it.
Smart. Can you give us a specific example? Like, how is an AI agent actually helping a customer in the real world?
Sure. The one they highlighted, which I thought was quite powerful, was their invoice reminder AI agent.
Okay.
They reported that customers using this specific agent are getting paid on average 10% more money. And maybe just as importantly, they're getting paid 5 days earlier.
Wow. 10% more and 5 days faster. For a small business, that's huge.
Think about cash flow. For a small business, getting paid faster, more reliably, that can literally be the difference between making it and not making it. This isn't just some small efficiency gain. It's a direct, quantifiable boost to their bottom line, to their cash flow. It really shows AI delivering tangible ROI.
That's a great example. Okay, moving beyond AI, another big focus is accelerating their push into the mid-market. The numbers here looked pretty impressive too. They're targeting this massive $89 billion market, businesses doing, what, 2.5 million to 100 million in annual revenue?
That's right, an $89 billion total addressable market, or TAM.
Why is this mid-market segment such a strategic focus for them?
Well, it's kind of a sweet spot. These businesses, they often have more complex needs than a really small business, but they're not quite at the scale where they need or want those super complex, expensive, full-blown ERP systems you see in large corporations.
So they're caught in the middle, needing more than basic software, but less than a giant system.
Pretty much. It's a huge market, often underserved, where businesses are outgrowing basic tools. And Intuit, with QuickBooks especially, has this natural pathway to reach them.
And they seem to be succeeding. The growth numbers were strong.
Very strong. Combined customers for QuickBooks Online Advanced and their Intuit Enterprise Suite grew 23%. And the revenue from those mid-market offerings up approximately 40%.
40% revenue growth in mid-market. That's significant momentum.
It really is. And they mentioned the number of new Intuit Enterprise Suite customers nearly doubled compared to just the previous quarter. So they're not just growing, they're accelerating their customer acquisition in that segment.
Okay, so how are they doing it? What's the strategy, product-wise and go-to-market-wise, for capturing these businesses?
It's a pretty sophisticated, multi-pronged approach. On the product side, they're doing quarterly releases for the Intuit Enterprise Suite. That signals a rapid pace of innovation.
Keeping things fresh.
Right. Like the July launch brought in better multi-entity capabilities. That's really important for businesses with, say, multiple locations or legal structures. Plus, AI-driven setup to make onboarding easier. And again, dedicated AI agents specifically for mid-market needs. Accounting, payments, finance, project management, embedding AI across the workflow.
And does it work? Are they showing ROI for these customers?
They cited a recent study estimating something like a 300% return on investment over 3 years for users. And get this, a reduction in manual work by up to 60%.
Wow, 300% ROI, 60% less manual work.
Yeah.
Those are powerful selling points.
Absolutely. If you're a mid-market CFO looking for efficiency and scalability, those numbers grab your attention.
Definitely. And how are they actually reaching these large, more complex customers?
Yeah.
It's not always easy.
A key part of it is strategic partnerships. They specifically highlighted a big partnership with a Rapidly growing top 25 accounting and tech advisory firm, a firm that serves over 14,000 business clients.
Leveraging the advisors.
Smart, very smart. These accounting and advisory firms, they're the trusted advisors for mid-market businesses. By partnering with them, Intuit gets access, gets credibility, and leverages their expertise. It helps with sales, implementation, support. It's a really effective channel strategy for scaling up market.
Okay. Now, we have to talk about the elephant in the room, the thing that likely spooked investors. Mailchimp.
Right. The drag on growth.
Management acknowledged it was a near-term drag. Revenue was slightly down year over year in Q4. What exactly went wrong there, and what's the plan?
Yeah, they were pretty upfront about it. The issues were mainly around usability and retention, which honestly isn't entirely uncommon after a major acquisition and during integration. Sometimes things get clunky or existing users don't love the changes.
Integration pains.
Kind of. But the important thing is management sounded confident about a turnaround. They expect Mailchimp to be exiting fiscal 2026, growing at double-digit rates again.
Okay, double-digit growth by the end of FY26.
Yeah.
That's a specific target. What makes them so confident?
Two main things they pointed to. First, better sales execution. They've improved their sales playbooks and boosted the sales force that's specifically targeting those larger mid-market customers for Mailchimp, so a more focused, effective sales effort.
Right.
Second, product improvements. They said they've made changes that are already resulting in the highest customer satisfaction scores Mailchimp has ever had.
Higher satisfaction is definitely a good sign.
It is. But they also caution, it's a subscription business. These things take time to flow through to the revenue numbers. So the ramp up might be slow initially, which again seems like sensible expectation setting.
Yeah, subscription models mean turnarounds aren't instant. Okay, let's shift gears to the consumer side. Also saw some really strong momentum there. TurboTax Live, we mentioned the 47% revenue growth, 24% customer growth. What makes that performance stand out so much?
That TurboTax Live acceleration is just, remarkable. It really validates their strategy of combining software with human expertise. It suggests consumers really value that blend, maybe for peace of mind, for confidence when filing taxes.
So it's hitting a nerve.
Absolutely. And that growth rate, 47%, significantly beat their own long-term expectations. It signals really strong demand for that kind of hybrid service. A big chunk of people are willing to pay a bit more for that expert touch, and Intuit's clearly capturing them.
And how does Credit Karma fit into this consumer picture? It also had strong growth.
Yeah, Credit Karma is doing well. Revenue up 34% in Q4, 32% for the full year. And importantly, that growth is coming from diverse sources like personal loans, credit cards, auto insurance. It's not just about credit scores anymore.
We're diversifying monetization.
Exactly. And the bigger vision here, Intuit's strategy, is to build one consumer platform. Use Credit Karma to drive engagement all year round, find monetization opportunities, and then ultimately make tax prep easier by leveraging that relationship and data when tax season rolls around.
So more of a continuous financial relationship.
Right. They want to make it less cyclical. They're using data and AI to personalize offers, focusing on higher value prime customers, expanding into insurance, money products, aiming to be a constant financial partner, not just a tax tool you use once a year.
Sounds like a comprehensive plan.
Okay.
Quickly then, capital allocation. How are they returning value to shareholders? What did the call say?
Strong commitment there. They bought back $748 million of stock just in Q4. That brings the total for the whole fiscal year to $2.8 billion.
Significant buybacks.
Yeah. And the board approved a new $3.2 billion share buyback authorization on top of that. So the total available for buybacks is now $5.3 billion. That signals real confidence from management in their stock value.
And dividends.
Yep, they bumped that up too. Approved a quarterly dividend of $1.20 per share. That's a 15% increase year over year, payable October 17th. So they're generating cash and actively returning it.
Okay, let's tie this all together now. Thinking about the investor context, especially that market reaction we talked about, the main driver seemed to be that conservative guidance. Can you break down those FY26 numbers again?
Sure. So for fiscal 26, total revenue guidance, $20.997 billion to $21.186 billion. That's 12% to 13% growth. Still double digits, but crucially, the midpoint was slightly below what Wall Street was expecting, around $21.1 billion.
Okay, a slight miss on the revenue outlook. What about earnings?
The non-GAAP diluted EPS guidance, that was actually pretty much in line with consensus, $22.98 to $23.18, which is 14 to 15% growth. So earnings look okay relative to expectations.
But the market focused on revenue, and maybe the near term.
Exactly. They really seem to hone in on the Q1 FY26 revenue growth guidance too. That was projected at about 14% to 15%, whereas expectations were closer to 16%. So, yeah, even though management's talking up this exciting AI story and long-term vision, the market zeroed in on those slight near-term misses.
It's that classic tension again, long-term story versus hitting the next quarter's numbers precisely. Do they give any color on the macro environment that might explain some of that caution?
They did. Painted kind of a nuanced picture. On the consumer side, they said consumers are generally stretched. Credit card balances are up, but only 4% year over year, much slower than before. And credit scores are down about 10 points for some groups. So signs of strain.
Okay, consumers feeling pinched. What about businesses?
For small businesses on their platform, it's a bit mixed. Revenues are generally flat, apparently. But interestingly, profits and cash flows are actually up year over year.
Flat revenue, but better profits. Maybe cutting costs.
Could be. Performance also varies a lot by sector. They mentioned real estate, advertising, manufacturing are down, but other sectors are up. So it's definitely not a uniform picture out there, which probably feeds into their cautious guidance.
Right. But despite that macro picture, Intuit still seems confident in hitting double-digit growth long term. How do they justify that?
Their argument rests on a few pillars. One, their early and deep investment in AI. Two, the sheer size of their market, that $300 billion total addressable market, which they've barely penetrated. They believe these factors will allow them to sustain double-digit growth, even if the macro environment is choppy.
Makes sense. Positioned in a huge market with a tech advantage.
Right. And they also made a key point about why the FY26 guidance might seem a bit lower. They said they'll be relying less on price increases in FY26 compared to FY25. So the slightly lower growth isn't necessarily weakening fundamentals, it's more a strategic choice, perhaps focusing on volume and value over price hikes this year.
That's an interesting nuance. Okay, one more strategic point. AI search. We hear a lot about how AI might disrupt search engines. How does Intuit see this playing out for them? Threat or opportunity?
They actually see it as an opportunity, a tailwind, which might surprise some people.
Really? How so?
Well, first they said AI search is still tiny, like 1% of overall search traffic right now. But within that 1%, top brands like QuickBooks and Credit Karma apparently get about 10 times more visibility than average.
Wow, so brand strength really matters in AI search results.
Seems like it. It speaks to their authority and the quality of their content. Plus, they pointed out their overall website traffic is up significantly, and less than 15% of it even comes from traditional SEO search anymore. They have diverse ways to reach customers. Credit Karma, for instance, has over 100 million users in its app. They're not heavily reliant on Google searches.
Diversified customer acquisition.
Yeah.
That's key.
Definitely. And crucially, they believe the traffic that does come from AI search tends to be from people much further along in their decision-making process. Higher consideration, higher intent. So it converts much more efficiently.
So lower volume maybe, but higher quality leads.
Exactly. That's why they're investing in it. They see it as a source of high-quality, efficient customer acquisition. And looking ahead, there's a potential catalyst coming up soon. They're holding an investor day next month.
The investor day. Always important.
Right. They explicitly said they'll use it to unpack why Intuit continues to have a very bright future. So expect more detail on AI, Mailchimp recovery, the whole strategy. Could be a chance for them to really reset the narrative.
Okay, that sets the stage nicely for our not financial advice segment. And let me stress again, this is purely for entertainment, a thought experiment. Absolutely not financial advice.
Got it. Disclaimer delivered.
So the setup is strong Q4 results, exciting AI story, solid mid-market growth. But the stock drops 5-7% because the guidance for the next year was slightly below expectations and Mailchimp is still recovering.
Right. The market focusing very much on the short term, maybe missing the bigger picture strengths.
Exactly. So here's our outrageous but plausible idea. A short-term contrarian play. Maybe thinking about buying the dip on Intuit stock, ticker INTU. Perhaps even using call options that expire shortly after that investor day next month.
Okay, explain the thinking there. Buying calls is a bet the stock price will go up, right?
Right. The rationale is that the market might be overreacting to those near-term guidance points, that Q1 revenue number, the current state of Mailchimp, while potentially undervaluing the really strong underlying performance.
Like the AI agent adoption, the 40% mid-market growth, TurboTax Live exploding.
Precisely. These are strong fundamental signals. So the idea is this dip creates a potential entry point if you believe management's long-term AI story and that investor day next month. That's the potential catalyst.
So management comes out, gives more detail, more confidence on AI monetization, clarifies the Mailchimp path, and the market reevaluates, looks beyond the next quarter.
That's the hypothesis. If they execute well at the investor day, maybe sentiment shifts and the stock rebounds from this dip. It's definitely higher risk playing for a short-term catalyst like that, especially with options. But if the market has overshot to the downside, there could be upside.
It's certainly a scenario where short-term market focus might create an opportunity for someone with a slightly different view, or at least faith in that upcoming investor day narrative.
So let's recap this deep dive into Intuit's Q4 call. We got this really interesting tension, don't we? Strong actual performance in Q4, genuine excitement around AI, real progress in the lucrative mid-market.
But that's all being weighed down, at least in the market's eyes, by conservative near-term guidance and the ongoing Mailchimp turnaround effort.
It really is a classic case study in balancing that ambitious long-term innovation story with the quarter-to-quarter demands and expectations of the market.
Definitely a balancing act.
Absolutely. And once again, please remember, this deep dive is purely for informational purposes. It is not financial advice. But as we wrap up, here's something for you to think about until our next deep dive. In this constantly shifting landscape of tech and finance, what really stands out to you about Intuit's juggling act? Trying to manage this ambitious long-term AI vision against the immediate pressures of market expectations kind of makes you wonder, how long can the market stay so hyper-focused on just the next few months? Something to mull over.